The Taiwanese index too trading above the flat line with gains of around 0.25%.
President Zelensky is going to be coming on Friday. That's now confirmed.
They're proposing to put on a capex of close to around 1,800 crores over the next 2 years.
So Nifty, of course, on Tuesday, which is the last session, ended lower, and of course, no signs of reversal yet. 0.2 higher on the Nifty, so let's go with that one first. 0.4 on the Nifty Bank.
Unrelated diversification, non-core diversification is always bad news.
It will take minimum another 3 to 4 years to, or 5 years to develop the brand for wires.
With this kind of change in risk weight, I think around 40,000 crore of capital would be released, which can translate into 4 lakh crore of incremental lending.
It is not that much like disruptive what market is reacting as per me.
The mid-cap index is down close to about 0.8%. The small-cap index is a cut of more than 1%.
If you look at it over the medium term, you do get a very consistent play out on what happens to the market.
Broader markets are the ones that are seeing significant amount of pain. In fact, if you look at the small cap index, continues to hover around with cuts of close to 1.7%.
Well, it's an all-boys team once again here on Closing Bell. We are coming to you from the CNBC-TV18 News studios. Markets are, it's like a traffic light for the Nifty, right? Red and green and almost literally unchanged. Mid-caps and small caps, significant pressure in selling once again. I'm Prashant Nair, with me my colleagues Nigel and Mangalam. Guys, hi.
Hi, good afternoon. Prashant, taking over from last Tuesday where you said nothing happens in the market, I bring on Mangalam, and that's exactly what's happening today as well. Absolutely nothing. I don't remember the time when I was on Closing Bell at the time the market was at even more than 20 points higher on the front line index.
And today's expiry day.
It's all well planned, Mangalam.
So we are flat as of now. We have Mangalam and we have expiry. So I don't think we'll end around 22,550. We should be much higher or much lower. So let's see how that goes. But you know, in today's trading session, to be fair, you have a lot of stocks that are seeing big moves. You know, you have these cables and wires players that are down for obvious reasons. In the last few minutes, take a look at Credit Access Grameen. The stock is up 18%. Massive volumes. It's at the high point of the day. But you know, that's telling you there are select counters that are doing well, and some of them still getting hammered. You know, so plenty of action in the broader market.
Yeah, sorry.
No, I was just saying, even if you look at the Nifty, even if it expires at 22,550, two things will happen. One, it will create history on the downside once again. 5 straight months of losses, the first time that happened since all the way since 1996. And the second part is all those who've written the 22,550 straddle, which is a call and a put together, will be making a lot of money, because that's the strike which has been most active since morning. We've been, you know, looking at this 22,550 sort of straddle out here. So for all those option writers, actually, if the market does nothing, it would be a great expiry for them.
It's almost like that. It's fixed on the tape, 22,550 as we speak right now. Nothing at all. But I mean, absolutely flat, nothing at all. But broader markets, right? Significant pressure once again. And I'm just looking at the NSE advanced decline is some 4:1 in favor of declines once again. So that's not good news out there. But I think, as Nigel said, lots of single stocks moving. Credit Access, I think by 10:30 it was up. It was significantly higher. I remember 13-14%, but it's now about 18%. And it's the #1 volume-led gainer on the NSE as things stand. Polycab is down 18% as the #2 place in terms of volume-led move. And that is, of course, on the downside, right? Credit is down 18, up 18. Polycab is down 18. There is UltraTech, which is down 5. Again, significant volume-led move. KEI is down 20%. Look at something like a BSE. BSE is down 6%. I'm not sure if this is a recent move. It was not there in the morning, at least. The fall happened at about 9. Yeah, actually, the big fall, the big down move happened about 9:20. So I guess, and then of course it's kind of plateaued out. It's been down since, but that's a big one. Inox India, we spotted this in the morning. It's up about 8%. Shriram Finance is up about 5%. Havells is down 5.5%, 6%, and Varun Beverages is down 6.5%. Again, I mean, you know, the big sell-off happened from about 470, 475 levels to about 440. which is where it has kind of plateaued out for the last few hours or so. So lots of specific single stock action with volumes both on the way down, more on the way down, but also some on the way up.
You know, you spoke about Varun Beverages. The entire consumer discretionary pack, the urban consumer pack, has come in for a bit of selling. So you pull up something like a United Breweries, that's moved to the low point of trade. Alongside that, you have United Spirits, that too has dropped to the low point of trade. And just pull up the intraday chart of Jubilant Foodworks. Jubilant Foodworks was holding up in the green as the analyst day is currently underway. We saw the presentation. No, major negative out there from the presentation, apart from the fact that Popeyes hasn't been mentioned as much as the street would have liked them to. But that stock too has seen a bit of a sell-off right now, even as the analyst day is underway. We are seeing this sell-off in a lot of these names, which are basically urban consumer discretionary plays. Nykaa, for instance, too, has now slipped to the low point of trade, a cut of almost 2.5% from the high point. So there are pockets which are seeing some bit of pressure, Nigel.
Well, that's right. I think easier said than done, but I think investors could take heart from what Mr. Virat Kohli said, post that innings. He said he ignores all the noise, he sticks to the basics, and he keeps at it. And ultimately, the runs come about. So I know it's a difficult times. All of our portfolios, in terms of the SIP, the mutual fund portfolios as well, that gains have virtually been wiped out. But I guess in the longer term, things should look up. And that's why I think maturity of investors is called for right now. And, I think you need to keep it going. That's what I'm doing as well. So just taking a page of what Virat said the other day. Ignore the noise, stick to the basics. The runs will ultimately come. So it's a difficult phase that market participants are going to. Mood is extremely somber.
Just try and hold on to your wicket. Just try and hold on to your wicket. Don't lose your wicket. In the stock market parlance, that would mean basically don't over leverage or don't get into any mistake that may make you adventurous.
The time for mistakes is gone, guys. Now you've got to just, you're in it. So you've got to just endure and get through this phase as well. So we'll help you do that. We'll get you lots of opinion. Let's quickly get in the first one, at least from a very near-term perspective. Mitesh is with us to tell you how to position yourself, any trades out there. And Mitesh, afternoon Nifty, and also just look at the mid and small cap indices because they're down another 1.5–2% each. So how are they set up?
So Nifty, I think, Prashant, nothing much has happened. In fact, you could have, if you're a Nifty trader, you could have been on a vacation and come back very happily. But again, as I said, I think, the pace of fall is declining. That's the only positive thing. I think, coming out of a negative movement, getting into sideways movement is not a bad idea, though I'm still not sure that we've begun a big contraction. But I think it looks like that 22,610, 15 and about 22,510, 510 to 22,500 is the near-term range. Let's see which direction do we break out from. My sense is that in case there has to be reversal, we have to have a stronger and much violent move, which can possibly give a bullish candle, which can engulf multiple in this negative, slowly declining channels. So, but till then happens, I think, just wait it out. And on the stock side, I have one buy and one sell. On the buying side is Naveen Florin, just trying to reverse from oversold levels. So we'll keep a very tight stop at 36.85 and look for a bounce back to about 3,800 plus kind of levels. And on the sell side is Sun TV, which has reversed on the negative side. So sell here with a stop at about 580 for targets of 550.
Okay, all right. I wanted your call, Mitesh, on a few of these steel names. Again, that buzzes that maybe we're close to hearing something with regard to protection. And if I pull up, some of these names, whether it is, Tata Steel, JSW Steel, NMDC, all of them have moved to the high point of the day. So any view on any of these names? And also the other rank underperformer has been Coal India. But in the last 1 hour or so, that stock has spiked up. We know valuations are okay. There's a dividend player out there. There is some buzz that maybe since now we don't have any state elections for the next few months, maybe that price hike could be pushed through, some part of it. So those are all the potential reasons, and that's why the stock is at the high point of the day. Any view on some of these metal names or the mining major, Coal India as well? Anything looking good on the charts?
See, before a couple of days back, if you just rewind the markets, we had good activity happening on the charts of Hindalco, and then SAIL also rallied. But I think that rally has fizzled out. So while today they are up, I don't see a big reversal kind of a thing happening, except Tata Steel, which has a positive structure, and if it can sustain about this 134 mark, which is only about 3.5 points lower, then I think good chance that it should attempt 141, and then maybe on the upside in the best case scenario around 148, 150 level. So that's about it. Could be a trading rally over here, but I don't like most of the names despite the fact that they are up today, except for Tata Steel, because there's no bigger sign of a reversal happening on the the upside.
Do you have a view on Bharti Hexacom?
Bharti Hexacom, no, I can't track. Sorry.
All right, take that point. Thank you, Mitesh. We'll come back to you soon. The stock of the day, definitely from the frontline end, is UltraTech. Under pressure post its decision to enter the wires and cables segment. Nigel, a couple of years ago, the announcement was on paints. Now it's cables and wires. Street is worried about, where it goes from here.
Well, that's right. The disruptors, right? That's the big fear. And UltraTech, late on Tuesday, they had announced that they're going to go ahead and they're looking at the cables and wires business. For this, they're going to be spending close to around 1,800 crores over the next 2 years. By December 2026, they expect the plant to be commissioned, and the plant's going to be located in Bharuch, which is in Gujarat. Now, why are they doing this? There's an industry tailwind because the industry is growing at around 13% approximately. It's an 80,000 crore industry that's expected to go to around 1 lakh. So that's the industry tailwind. Backward integration could help them because Hindalco is into aluminum as well as copper. So maybe some kind of support on raw material. Point number 3 is they're talking about UltraTech Building Solutions business, which has around 4,400 outlets. And they want to build on that. How do they fund this? Well, via a mix of debt as well as internal accruals. And remember, for UltraTech Cement, this will be hardly 10% of the total annual capex that they spend. So it'll be very, very small. They throw up cash flows of close to around 10,000 crores approximately. So it's very, very small in that scheme of things. What do the numbers suggest? They're putting 1,800 crores. Revenues at peak could be close to around 7 to around 8,000 crores. And margins that they'll generate will be in early teens. Now, if you're looking at the profitability at the margins as well as the ROC that comes up for you on the screen, in comparison to their core cement business, these margins will be relatively lower. But in terms of ROC, that's return on capital employed, it will be relatively better. The big question, why doesn't the street like it? The street wants them to focus on your core business. You're the master of cement. You stick to cement and keep it as clean as possible. They haven't done that. So capital allocation woes have returned. Point number 1. Second factor is, if you want to do this as a group, you should have done it under Grasim. Why are you putting it under UltraTech? So those are the two pain points. Jefferies, they had come out of the north. They're saying we're positive on the stock. If there's a knee-jerk reaction, they would consider it as a buying opportunity. So that's what they had to say. For the time being, the stock is down close to around 5% or thereabouts. And UltraTech basically has announced 1,800 crores of capex. They have lost market capitalization of around 12,000 crores. But the ones that are getting harder hit are the entire cables and wires businesses, because put it together, the total market capitalization that's eroded today is close to around 30,000 crores. So let's find out from Upasana more about that. Upasana, my big boy UltraTech making an entry into your space. Your space is very, very, nervous, and they're fearing that this is that big pains moment. Tell us more, Upasana.
Certainly, Nigel. My sector, that is cables and wire, is feeling the pain. The street fears the competitive pressure from the entry of UltraTech Cement into the cables and wires segment. Now, the company aims to meet the growing demand from cables and wires across various sectors, and the industry tailwind also remains positive, as cables and wires industry has witnessed a revenue CAGR of 13% in the past 5 years, that is from FY19 to 24. Now, let us look at the impact on cables and wires companies. Now, this may intensify the competition for existing large players. Now, we talk about FY24 market share. The top players such as Polycab, it stands at 26%. KI Industries stands around 12%, followed by Havells, which stands around 11%. Now, HSBC is of the view that this move is likely to have a material impact on revenue growth and margins of these players beyond FY27, that is after the commissioning of the plant. And it has lowered its target price between 7 to 23% for all the major players in the space. It has given a buy rating on Havells with a target price cut by 6.5% to 1,730 per share. Polycab, it has given a buy rating, target price cut as high as 20% to 6,250 per share. KEI, it has given a hold rating and target price cut by 23% to 3,450 per share, and RR Kabil, it is given a buy rating with a target price of 1,260 per share. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other housing B2C players, that is Phenolux Cables and Havells, and it says that the Polycab continues to remain the preferred pick in this space. Morgan Stanley says that this move has surprised the street, but it does not see any concerns going forward. So all in all, these sector remain in focus. And now when we talk about the valuations of these companies, even after the steep correction, valuations are still above 5-year average is what we are seeing. So this space certainly remains the key focus and theme in today's trading session.
Thanks a lot, Upasana, for putting all those factors down very, very neatly. So for the time being, the street is very, very nervous on prospects of players from the cables and wires business. But we spoke to a couple of players, spoke to both KEI Industries as well as RR Cable. Both of them, they believe that things are fine. The industry has enough of capacity to take in a new player as well, and they are confident about growth and profitability. Let's hear them out.
This and the market space is big enough to give space to another player. Number one. Number two, UltraTech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them. There will be no problem in margin expansions because this comes by economies of scale. And I have said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. There is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore, or next year the capex will be 1,000 crore, which is ongoing at our new plant coming up at Sanand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and our growth trajectory will remain the same.
This is very big industry, and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market, and it is very like on negative side market is concerning. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me.
All right, let's get an expert view. We have Manish Valecha, the research analyst at Anand Rathi Institutional Equities, who joins us on the show. Hi, Manish. Good afternoon. Good to see you in. Normally, we call you and we ask you, what about the cement industry? I know the last many years, we have had a lot of chats on that. But now let's talk about the space that's being challenged, because the big boy UltraTech is eyeing the cables and wires business. All the stocks are down. What is your recommendation? Do you believe that this is a good buying opportunity? Because a lot of investors are very, very nervous about this big conglomerate getting into their space. Your take.
Hi, Nigel. Thank you for having me on the show. A quick, working that we did on the announcements. So basically, if I work out on UltraTech's plans in terms of numbers, they are looking to commit 1,800 crores in capex, which on a 3.5-4 times asset turn gives them a 6,000 to 7,000 crore of revenue. Now, let's say 90% utilization with 8 to 9% PAT margin gives them about 600 to 650 crores of profits in the first year of full operation. Even if I give them a 30 to 40 times of multiple, that works out to be 22,000 crores of market cap. But the impact today in the top 5 players itself is about 31,000 crores, which has been wiped out. I think from the cables and wires business perspective, there is slightly an overreaction, and this could be an opportunity to buy into these names.
In that case, what would your pecking order be?
We like Polycab, followed by KEI, and then Finolex cables.
Just a left field thought. If UltraTech really wants to be very aggressive in this, they can totally erode the margins of all other players, right? Lead into a price war because with the kind of cash that they generate, it won't make a very big dent to their EBITDA, but in return, they will get the entire market. And as a result of which, all the others will get disrupted. Is that a possibility? Do you fear that would happen?
Yes, that's very typical of both UltraTech as well as the group. I think we have seen it multiple times, both in cement as well as on the paint side. I do not deny that there could be an impact in the first or second year of operations where there is a fight for market share. And maybe once they have reached a 3 to 5% market share, I think that is when the margin or the race for cutting on margins will end there. So we believe, yeah, maybe there will be 1 or 2 years of impact, that too in FY 28 and 29. That could disrupt the market a bit. By the time the other players will also gear up in their defense. So I don't see a very big impact coming in.
You don't see a very big impact coming in, but there's a possibility that it could happen in FY 28 or FY 29. But you would remain a buyer on these stocks, right? Are we getting that correct?
Yes, I think the reaction to a large extent has already happened. So yes.
Okay, so you think almost all the bad news is in the price post today's damage, right?
Yes, more or less. Yes.
Okay. All right, Mani, it's just a question. Everyone's talking about, because of recency bias, everyone's talking about what happened in the paints division. But we need to keep in mind that those paint stocks were trading at multiples of 65, 70 times as well, which we did see a big derating out there. These companies are in the vicinity of 30 to 35 times odd. Do you think there's a valuation derating that will take place also? Or do you think, it's pretty much okay right now post this correction?
So I think there were two major differences. One, as you mentioned, they were at 60, 65 times. And second, that industry itself was not growing, right? Compared to these companies, in fact, the impact should have been much lesser, given the industry itself is growing at 11 to 12% CAGR for last 3-4 years, and in fact going forward also looking at 13% kind of CAGR to grow in the next 3-4 years, and they are trading at a much lower multiple with given their current return ratio profile. So I don't think a similar kind of an impact should be warranted for wires and cables. What happened in paints?
All right, Manish, thank you so much for joining in and giving us your view on the space. You remain a buyer. You believe that today's reaction has everything priced in. And, Polycab and KEI in particular are stocks you like from the pack that has seen the most amount of destruction in today's trading session. Let's move on then. Let's get in Deven Choksi of DR Choksi Finserv Private Limited as well. Deven, it's a pleasure speaking with you. There are two big stories today. One is the cables and wires. The other one is the NBFC pack. The NBFC pack, because of RBI's relaxed lending norms towards microfinance institutions and NBFCs, has all of them buzzing today. The top nifty gainer right now as we speak is, Shriram Finance, and you have a bunch of others as well. Credit Axis Grameen, for instance, which were pointed out at the start of the show, up in double digits, almost 20%. Do you think this is a big game changer or perhaps a very good relief for this space, and as a result of which, would you be a buyer here?
Good afternoon, Mangal. Well, I think on the overall basis, with a 40,000 crore book size available from the RBI side to the banks, I think could translate into a significantly large amount of loan book as far as the ability of NBFCs to lend further is concerned. And that could possibly be a game changer in a way that I think the liquidity infused could possibly bring the growth at a faster pace. Now, I think generalizing that would be a little bit tricky because in the microfinance space, I think the major amount of stress is on the NPA as well. So some of the NBFCs, which are larger banks, larger NBFCs, I think they would probably, be cautious in lending and expanding their book on that side. So I think it would be very selective. In my viewpoint, I think the likes of Bajaj Finance could possibly remain very, very strong in form, given the kind of money that is getting released and further, I think, available for the purpose of expanding their book size, which is already about 340,000 crores. So in my viewpoint, I think selectively, one will have to look at this entire book, though positive, but companies will remain cautious in lending and expanding their book, at least I think in the microfinance space.
Right. Just hold on to that thought. On Tuesday, we had pointed out a bunch of stocks which would be in focus on account of getting out of F&O, right? We had weird moves coming in, wild moves coming in on Canfin Homes and Bata India on the previous trading session. Now look at Sun TV. Sun TV gets out of F&O from today as well. So a lot of unwinding taking place out there. The other one we're looking at is United Breweries. So Bata is down about 4.5%. Sun TV is the one which has taken a harder knock. More Swift down about 6.5%. And just pull up the intraday chart of something like a United Breweries as well. That too has moved to the low point of trade. The other stocks which are on our radar and the ones which are getting out, City Union Bank, that too is at the low point of trade. And we are seeing some, decline in names like Metropolis too. Metropolis too has fallen at to the low point of today's trading session. So as we move towards expiry, all these 16 stocks, the list of which once again comes up for you on the screen shortly, will see some bit of wild moves as positions are unwound as we move towards expiry, and these stocks cease to trade in the F&O pack itself from tomorrow. With that, we'll slip into a short break, come back. On the other side, we have Vivek Paul of BlackRock Investment talking about the market fundamentals on the other side.
Okay, welcome back. We got the market, which is absolutely flat, nothing at all, except of course lots of single stocks. If that is what you're focused on, but the Nifty will not give you that impression because it's almost unchanged from yesterday's close. Vivek Paul is head of portfolio research at BlackRock Investment Institute. Vivek, good to have you with us here. Thank you for joining us. You know, the question for that a lot of people are asking is maybe the price damage, and I think the point also is that India and the US have been really tightly correlated. for about 2-3 years now before this leg of correction started. So now many are wondering whether, the correction in India has been meaningful, especially at a stock level. In the US, are we just at the beginning of a pullback, a correction? And if that would happen, what would it mean? So just start there, Vivek, in terms of how you're thinking about these two markets.
Hey, Prashant, great to see you. Thanks for having me on again. So, yeah, I think you're right that for a bunch of time there was a really strong positive story that was being made for India and the United States, and happened at a similar time. I think we're now in a period where we're going to start to see more regional divergence between those two countries and more broadly. We're not in an environment where there's one common story that means that all markets are going to go up or down. And I think in the United States, it's very much a story about AI, about tech, and in India, it's a story about a cyclical downturn and the kind of the period of kind of consolidation around that. On a go-forward basis, I think structural opportunities also look different. I think in India, there's like a broad market dynamic which is linked to the demographic story. I think in the United States, there's a broad story as well, but also their leadership in AI, I think, is crucial to their positive case going forward.
All right. Hi, Vivek. Good afternoon and good to see you in. This is Nigel on this side. Vivek, in your note, you've mentioned that India as well as Taiwan, they looked a little bit expensive. Now, the Indian markets have pulled back, and, a lot of economic indicators on ground actually say that our economy is in fine shape. The markets could be wobbly, maybe it ran ahead of itself. But now some of those, those factors on ground are actually looking good, whether it's credit growth and various other, factors. And given that valuation-wise, we're a little below the long-term averages. Do you think the Indian markets have corrected enough? Because I'm looking at your top markets that you like. I think you like the Japanese market. China, you had preference out there as well. Is it time to look at India now?
Hey, Nigel. So I agree. So if I look at the long-run asset allocation recommendations that we make, so if you are holding an allocation for the next 5 to 10 years, India would actually be one of our top picks. So on a sort of structural basis, we're telling a story of leaning into India, especially given the correction we've seen. Now, I think what you're referring to is our shorter horizon views of maybe sort of 3-6 months, where actually there continues to be uncertainty. It's linked to tariffs. It's linked to a bunch of other cyclical domestic factors. And I think that's why, as of right now, in the very near term, maybe there are other areas where we kind of lean into more. But if you had a 5 to 10 year horizon, India would indeed be one of those areas we'd hold above benchmark.
So what would be the things that would have to change for you to change your short-term horizon for India as well? Do we have to fall more, or do you have to look at some more high-frequency data, or maybe China has to fall in a little more trouble than what India is in right now?
I think it's a relative story, exactly to the point you made. So I think, we've been overweight on a near run China for a little period of time. We see there being opportunities, particularly with the DeepSeek news around the tech industry there in particular. So this is a relative story as much as it is an absolute story. Valuations for us actually don't look particularly stretched on long-run measures for India. They're stretched relative to comparatively recent history, but if you assume interest rates in the future look different to how they have in the past, we don't actually find them that expensive. So it's more to do with certainty and relative value opportunities elsewhere. In terms of certainty, it's hard to see how we will get certainty around some, for instance, key cyclical dynamics around things like tariffs in the very near run, which is why for the period of time now, it's not really something that we're looking at. If there was to be a major correction that we thought was mispriced, of course, we would look there. But I think for us, it's more of a story whereby once we get that certainty over near run dynamics, that's when we lean in.
But would tariffs matter so much for India? Because, a large part of our economy is domestic focused. A large part of our economy is, consumption oriented as against export oriented. Would tariffs impact just those specific sectors, or would it impact the market on the whole?
Well, it's a great point, because I think it depends not just on the direct situation with India, but also it depends upon more broadly the global dynamic too. And anytime we're talking about this, there's a lot of uncertainty that we've got to consider, right? So uncertainty around the levels, uncertainty around the pass-through mechanisms. So yes, I think that's a factor to consider. But again, we take a step back. There is uncertainty at a macro level more broadly. There is policy uncertainty when it comes to the path of inflation, which existed before the last few months and will continue to exist into the future. That has an impact on the relative strength of the US dollar, as well as some of the other dynamics we're talking about. So I think there are structural dynamics that tariffs play into, but it's not just a tariff story.
So in the near term, Vivek, what's it? India versus China. What's your preference was China, but now is it getting a little bit skewed in terms of that preference? Is India getting some points as well?
Well, this
just
is
in the near
point,
term.
I think,
In the near term.
Yeah, in the near term. I think in the near term, it continues to be a story for us where we lean into China now. I think if you think about the drivers of that, the technology story, the broadening out of the technology story, that is something that continues to favor China. So on a relative basis, we think we'd continue to be there for now. But exactly to the point that we've talked about earlier, when we start getting clarity around some of those uncertainties on the Indian picture, and if we have this continued bull market run in China, then the relative valuation story becomes a little bit different. So for us right now, on the relative basis, there's still room to run in the current positioning that we have.
Vivek, just very specifically, do you think the top is in for US Magnificent Seven?
Okay, so
it's been an exceptional run, and
it has.
Yeah, sorry, go on.
I'm sorry, Prashant. Sorry to interrupt. So, look, I think it all depends upon what you believe in the future, right? On any historical measure, you're right to highlight the fact that those stocks are expensive relative to history. But relative to history, I think, is a crucial point. If you start to take out, for instance, past earnings and think about what future earnings could be, yeah, you need to see something in the future that is unlikely relative to history, but it's not unprecedented. You need to see something that might be in the course of the top 10% relative earnings path in the future to justify current CAPE levels. But if you believe, like we do, that we're in an environment of a structural transformation and AI is going to be as important when we look back as previous industrial revolutions, well, maybe that can indeed occur. So undoubtedly, it's the case that relative to past measures, it's expensive. But I don't think that automatically means that you should not be holding them. And we would continue to hold those large stocks as of now.
You continue to hold those large stocks as of now. Point taken. It'll take a brave person, right, to sometimes, I think if you go back and look at the example of 99, 2000, even people who eventually turned right, were wrong for a long time, and stocks ran up. You think we are in that kind of a moment, the final hurrah in that sense, Vivek, or you don't think so? This is okay, and it's durable, perhaps a little slower, but basically we're headed higher in that space.
I think we're headed higher, and I think the reason is that we're still to see, if you like, only the start of the potential impacts of AI globally. Right? We're still scratching the surface in terms of the adoption that could occur. We're still scratching the surface in terms of the productivity benefits that could occur. Now, I'm not saying that there's no chance of a correction in the near run. That always exists, and that exists perhaps even more so in an environment of macro uncertainty that we're seeing. And you're right to point out the big valuation upswing. But I think, whether or not the current companies are all the winners of the future, I'm not sure. But I do believe that the US has some of those companies that are best placed to take advantage of the structural transformations that we're seeing. So look, to summarize, yes, you're right to point out that it's expensive relative to the past. And it would indeed take a brave man or woman to kind of call the top. I'm not doing that, not because I don't want to be brave, but because I genuinely believe that this is an AI revolution that we're still scratching the surface of.
Yeah, absolutely. Vivek, thank you very much for joining us. Good speaking with you. Appreciate your time here. Still a grand total of 6 points on the Nifty. 22,550 is where we're at. We take a break. We are back. We'll tell you what's happening in dealing rooms. Nimesh has been working the phones. He'll get you a real-time intel. So that's coming up in just a bit.
Welcome back. Well, keep an eye out on a few stocks. GNFC is one such stock that's down close to around 10%. I think that's one of the stocks that are moving out of the F&O market from tomorrow itself. So today's the last day. That is the reason why that stock at the low point of the day, 10% down. PVR, Inox as well is now down close to around 6.5%.
That's the other one that's going out as well.
Yeah, so a couple of these names, they are down because they won't be available for trading in the F&O market from tomorrow onwards. Today is their final day, and that explains why we're seeing some bit of big reaction on some of these names. Let's get in Nimesh though, as promised. He's been working the phone lines. Nimesh, what's the buzz? How's the mood?
Well, Nigel, the mood is completely downbeat and panic, right? Clearly, now there is panic now. There is so much of pessimism in the market that every pullback wants to get sold into. So that's the kind of mood. And actually today the best barometer is the cable and wire stocks, right? Everything is down at day's low. Any pullback attempt got sold into. And just look at the numbers. For an 1,800 crore capex that UltraTech wants to do, we've seen a market cap erosion of close to 50,000 crores across all these names, including UltraTech. So, that explains the kind of mood which is there in the market currently. There is selling from the FI, so that trend continues. Within that, I guess, again, there is selling in the real estate names today. On the other side, a bit of buying, or you can say a bit of shift happening to the financial stocks. Largely, they are under-owned, and valuation is at comfort. And the fact that now the regulator has turned a bit positive is something where investors are taking a note of that. And so clearly there is a bit of sector shift happening to the financials. But net, the mid-cap index is down 1%, small cap down 2%, and there is clearly panic across the broader market names, Nigel.
Right, we take that point. Nigel spoke about a couple of stocks which were falling on account of exiting F&O tomorrow. Atul, on the other hand, is moved to the high point of trade. That is another stock which is exiting F&O as well. So maybe some bit of positioning or position adjustment which is taking place out there. But Nimesh, speaking about individual stocks, while the mood is downbeat, do we have some tidbits on individual stocks?
Yes, Maglam. So the first stock on my list is Oberoi Realty. I spoke about selling across the real estate name. Oberoi stands out on back of aggressive selling. So that's been a big underperformer of this series. And even after the recent underperformance, there is supply in stocks like Oberoi Realty. So that's the first name. Second stock is AB Capital. That's been buzzing in trade today, largely on back of buy flows, but also there was a Morgan Stanley tactical buy as well. Again, valuation comfort is there, and the fact that a lot of brokerages have turned positive. There's a bit of buying interest in stocks like AB Capital. The third stock is Redington India. This is interesting. In a weak market throughout this series, this month the stock is up 20-odd%, and consistently for the last couple of days, I'm getting a sense of buying flows at leading effect. So it looks like some accumulation is happening in Redington at current levels. So that's the third stock. And the last is Dolphin Offshore. We normally don't talk about this name. There was a large block in pre-open today, and after that the stock is locked at 5% upper circuit. I understand one of the FPI holder, who's a large holder there in Dolphin Offshore, that's the potential seller in today's block. So disclosures in terms of who's bought could be very interesting in Dolphin Offshore.
Okay, all right. We'll keep an eye out on that. Nimesh, thanks a lot for giving us that quick take. By the way, one positive is, the number of stocks that are advancing from a little sub that 400 odd, it's moved to around 500. So a couple of names, I think, are seeing good amount of buying, and they've turned around a little bit. So it's headed towards 500 stocks. Mitesh Thakkar is back with us. Mitesh, the market's not moved at all. 2-point move on the Nifty. What's your take?
I think that's the thing here. I think hardly any kind of movement happening. So, well, I would say that just avoid taking the index, trade with stock-specific biases. I think that's something which may be a good way of. Sorry.
Give us your picks.
Sure. So on the stock side of BTSC and Zomato, with a stop at about 227.5 for targets of 233 to 34. Maybe even higher levels. And Torrent Power is something which has come on my radar. Torrent Power, and that's a BTSC as well. I would suggest to stop just below levels of 1304 and a target of 1330 on the upside.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's hop across to my colleague Ritu. She's here to give us all the latest with regard to UCO Bank's fundraising plans. Ritu, take it away.
We've been given to understand from our sources that state-run UCO Bank has deferred its foreign roadshows for the proposed 2,000 crore rupee QIP that the bank is looking to raise. This roadshow was scheduled to take place on the 24th and 25th of February across Hong Kong and Singapore, but has now been deferred. Now, our sources within the bank indicate that the bank will now attempt to hold these roadshows in the second week of March or later. Keep in mind that the bank had planned this 2,000 crore rupee QIP, which was recently approved by the Government of India, to comply with SEBI's minimum public shareholding norms. As of December end, the Government of India held about 95.39% stake in UCO Bank, and after this 2,000 crore rupee QIP, the government stake was expected to fall by 3%. UCO Bank's capital adequacy ratio stood at about 16.25% and its Tier 1 capital at 14.17% as of the end of the third quarter. Now, the management had guided that they won't close this QIP in the current financial year, which means in this quarter itself, but with the deferment of the IPO, it remains unclear whether or not UCO will be able to conclude this QIP in the month of March itself.
All right, Ritu, thank you very much for that. Let's move on to another interesting conversation that we had earlier in the day. Remember, corporate stalwarts like Uday Kotak, Harsh Goenka, and now economist and PMEAC member Sanjeev Sanyal have spoken out about the decline in interest amongst the next gen of big business families in running and building and expanding their own businesses. Instead, they say what's interesting many of these sort of next gen youngsters is managing money and being in stock markets. So I caught up with Devina Mehra and Deepak Shenoy and sort of for a quick discussion around this. Lots of reasons, lots of opinion. So just want to play out a quick bit from this piece. Listen in.
There are two or three aspects to it. For the first, let me just read out a quote to you. Our youth now love luxury. They have bad manners, contempt for authority, show disrespect for their elders, love chatter in place of exercise. They contradict their parents, gobble up their food, and tyrannize their teachers. Guess when this quote is from.
Sounds like my kids.
This is from 79 AD, graffiti on the walls of Pompeii. Oh. And the actual quote goes back even further to Greek plays. Right. So this is what every generation thinks of the next generation, that the next generation is going down the drain, not working hard enough, and so on. So that's one part. The other part, of course, is that businesses, especially manufacturing businesses in India, are difficult to run. I was talking to an older industrialist who sold out his business a few years ago, and now he was telling me that his son has opted to start a manufacturing business. And he said, I actually dissuaded him for a while, saying, do you know what it entails, you know? And because there's so many regulatory authorities, from the municipality to getting water, electricity, labor laws, just so many rent seekers. And he says, because we've done it before, we could do it. But my son said, you know, if we don't do it, who will do it? But that's the one hurdle. The other thing is, even if you look at the history of business families, normally beyond generation 3, it becomes difficult because the first person had the hunger, built it. The second generation also saw some part of that struggle. The third generation is normally born in luxury. So so maybe a new set of hungry entrepreneurs take the place of the old business families. That is also, but the fact is it is difficult to do business, especially manufacturing business in India, no doubt about that.
But you began with a very fundamental basic point. Each generation feels that
yes,
the next generation is useless. It's not. I mean,
yes, but human civilization has continued to progress. So obviously that's not the right viewpoint.
Absolutely, absolutely. I think you make some very good points. Deepak, come in on this. Where do you stand?
So, I mean, Prashant, I completely agree. I think my thing is, my contention is with one point. Why do we need the children of rich people to set up the next set of industries? Isn't it so that the hunger that the normal person has to rise through the ranks or to build their own businesses is what's going to drive the next set of industries? So whether it is, look at a lot of industries that have been set up. A lot of them have been set up by first generation entrepreneurs. Where are the next set of first generation entrepreneurs? I think the idea now is the science of the children, or the children of those who have become rich are now investing in those companies and calling them startup investing or whatever it is. and then also spending the money, which is both, I think, are great things, because if you don't have the hunger, at least you give the money to the person who has the hunger. And secondly, you spend so that it increases the incomes of all the people who provide you the services that or products that allow you to spend. So I think both things are useful. We are complaining, I think, mostly because we think that this is a misallocation of capital, but it's not a misallocation of capital. They are actually investing in other businesses. They are not going and buying gold and real estate. So I think in that context, this is not a bad thing. We should encourage new entrepreneurs to come in. Whatever barriers there are for new entrepreneurs to come up, I think we should change that. It's like, I sweat in a factory so that my children need not. But just because, let's say, I become rich enough, if my children chose to sit in an AC office, they will just have to use that money to fund someone else who's going to sweat in another factory. So I think that that process should continue. And like Devina said, we will always think less of the next generation. There was a number of people who are currently, who are big businessmen, were thought of as people who may not be able to run their parents' companies when their parents passed away and so on. But turns out some of them were actually quite capable. So I think some of it may be unfounded as well, that they won't be able to do it at all.
But both of you agree, Deepak and Devina, Deepak, you go first, that this actually is happening. It may not, it's right or wrong is a different matter, but this essentially is the trend. I mean, it's clearly visible in the businesses that you speak with, both of you speak with so many businesses, long histories. Deepak, you agree, right? It is happening.
Yes, some of this is a natural consequence also, because you sell your business for a few thousand crores. Now, to start a new business also may not take that few thousand crores in the first place. And then the scale of starting something at a few thousand crores is different from starting something at a 50 or 60 crores. So you choose to instead say, okay, listen, I'll spend my time diversifying, investing in other people's businesses, which I understand very well. Very few people sit in there saying, listen, I'm going to go build the next big massive thing. And those people who have the vision, of course, they will go ahead. But a lot of people, and this is worldwide, not just India, I think it is in the US as well, it's in Europe as well. The next gen need not necessarily run the businesses that their parents set up. Sometimes they hire external managers. And that's why professional managers take over large businesses, even those with names.
Okay, well, you can go online, find the entire discussion. We'll continue to play out, some of the sound bites from that chat. But it's a discussion which is happening online, offline, and lots of opinions, of course, coming through as well. We'll take a quick commercial break here. Markets are down about 10 points. Here's some good news for our viewers. India's business news leaders now a click away, introducing CNBC-TV18. It's an all-new app. Get instant access to breaking news, in-depth articles, financial world updates at your fingertips. Download the app now from the Apple Store or Google Play Store, or just scan the QR code on your screen now.
You're watching us here on Closing Bell, 4 minutes to the end of February series expiry. And it's a very, very interesting market which is playing out right now. Typical of expiry where the index is stuck to one level itself. The Nifty, you would see, is down about 14 points. That's not much looking at the way the Nifty Bank has fallen. Pull up the intraday chart of the Nifty Bank. When we started the show, the Nifty Bank was up by about 2/3%. It's given up nearly all its gains and currently sitting with just about 40-50 points in terms of gains. So you would say, what is it that is supporting the Nifty while the Nifty Bank is dragging it down? Pull up two indices. One is the Nifty IT index. So, Wipro has moved to the high point of trade. Infosys has done well. You have the IT index, which is supporting the index. So there has been some recovery from the lows from there. And the second one is Reliance. Pull up the intraday chart of Reliance. That stock too has recovered about, 0.75% from the lows, currently at the high point of trade. So you have Reliance and IT doing, some support to the Nifty as against the Nifty Bank, which is dragging it lower. All in all, the net impact on the Nifty is just about 15 points. Classic expiry related play which is taking place out there, even as the broader markets continue to sell off. The mid-cap index once again at the lower end of today's trading range. Good time to welcome Ambrish Baliga on the show. Ambrish, in a market which has seen such a big correction, I'm sure a lot of stocks have caught your attention when it comes to becoming attractive after the fall right now. Do you have any on your list?
Yeah, I've got one stock for today, which is Gabriel India. It's a key player in the automotive suspension industry since the last 60 years plus. They manufacture shock absorbers, struts and coil springs and supplying to OEMs as well as aftermarket. And they have a very strong market share of about 40% in the aftermarket channel. And they are present across the segments, two-wheelers, three-wheelers, where they have a 65% market share. About 23% is in passenger cars, about 10% of the revenue comes from commercial vehicles, and they also provide suspensions for premium coaches for the railways. Last few years, they've been focusing on e-two-wheeler segment, and they've developed a lightweight, energy-efficient suspension system, and currently they have about 87% of the market share in this segment. And recently they diversified into the sunroof category, and that's the other growing vertical. So the company has a vision and goal to become the top 5 shock absorber manufacturers of the world. So that's a decently tall task and should be achievable in the next couple of years. So expecting an EPS of about 21 for FY27 with a target price of about 630.
Okay, all right. Hi, Ambrish. Let's squeeze in one more. Trend, like it or not?
In fact, Trent, I still see a further fall from here, looking at the way consumption has slowed down and the sort of pressures which are there as far as Trent is concerned on their margins. So, at levels of closer to about 4,200, 4,300, I think one could look at buying Trent. And at those levels, it becomes decent from a valuation perspective. Because I think about 2 months back also you had asked me, and at that time also I told you possibly levels of 5,500 or 5,000. But then, when it came to those levels, we have revised our target down. So closer to about 4,200, I think we should look at it.
Got it. Okay, all right. Ambrish, we got a lot more questions for you, and we'll follow up with that in markets forward. But for the time being, we need to wind down the markets. Well, we're going to be going home virtually at the low point of the day. It's an expiry-related factor that played out towards the end. What dragged in today's trading session? UltraTech Cement being a little too ambitious for what the street liked. Stock down 5%. You had Trent that was down close to around 3%. Once a darling, 8,000 rupee plus. Now it's down to sub 5,000 rupees. Bajaj Auto 2.5% low in today's trading session. And Mahindra was giving signs of a fight back. Well, that got sold into in today's trading session, down close to around 2.5%. What did well? Well, some of these NBFCs and lenders from the financial space, they did well. Shriram Finance, finding its winning ways, up close to around 5%. Bajaj Finserv, Bajaj Finance, both of them did well. Hindalco, the Kotak upgrade seems to have done the trick for them. That stock was up close to around 2%, and Sun Pharma as well was higher. But Manglam, the real pain was in the broader markets. Tell us more.
The pain continues for the broader markets. And as we speak, the Nifty actually has ended a historic series once again, down 730 points for the February series, making it the 5th consecutive series of losses for the first time since 1996 itself. So that's as far as the expiry-related play happened. The broader markets down almost 700 points for the mid-cap index, 2,200 stocks in the red, for almost 473 stocks in the green. What were the ones in the red? It was the cable and wires players that took everyone's attention today, down anywhere between 10 to 20% depending on the name you're looking at. Polycab at one point down now 19%. KEI Industries down 21%. We had a sharp cut on names like Havells, etc. as well. The other group of stocks that actually sold off were the ones that are exiting the F&O trade from tomorrow itself. So we had GNFC down about 10%, a big cut on names like PVR, Inox, among others too. Varun Beverages was one which was down almost 7% in today's trading session from the broader markets as well. A couple of stocks that did better. We had Just Dial, which ended about 6% higher. Ather was up 5%, and a lot of these NBFCs which did a lot better on hopes of some more relaxations coming in from the RBI. So AU Small Finance Bank, we had Chola and L&T Finance, all of them higher.
Okay, well, I think we're going to wrap up things here from all of us. Goodbye. Thank you very much for staying with us. But don't go anywhere. Markets forward will pick up on all the action in just a bit.